We shall commence this module by studying about capital asset pricing model. The Markowitz portfolio theory explains how the investors should choose the efficient portfolio based upon their utility preferences. The capital market theory is built upon and is an extension of the Markowitz model. In that, it hypothesizes how the investors do behave rather than how the investors should behave, as explained by the Markowitz model. The capital market theory develops a model for determining the price of risky assets in the capital market. Risky assets are those assets that carry an uncertain amount or rate of return. In fact, these depend upon the market forces and the efficiencies in the market system. For example, equity shares, corporate debentures, mutual funds, etc. The concept of risk-free assets is very vital to the development of capital market theory. Risk-free assets are those assets or investment avenues that carry a fixed or certain amount or percentage of return. These are free from default risk, but in practice, these are still prone to risks arising from fluctuations in the interest rates and inflation rates, as a result of which the real returns get negatively affected. A few examples of risk-free assets are treasury bills, dated government securities, etc. Now, we will try to cover the following 6 objectives. After studying this module, you shall be able to understand the concept of capital asset pricing model, number 1. Number 2, analyze the capital market theory and CAPM. Number 3, learn the concept of risk-free asset, risk-free lending and borrowing. Number 4, discuss the assumptions of this model. Number 5, explain the concept of capital market line and security market line. And finally, number 6, create efficient frontier under CAPM and CML. Let us now discuss about the assumptions of capital market theory. This has the following 7 assumptions. Number 1, all investors are expected to make decisions based solely on their assessment of risk return. They follow the idea of Markowitz efficient frontier and choose to invest along the efficient frontier. Next, the investors are assumed to lend and borrow any amount of money at the risk-free rate. Next, the time horizon for choosing investments is equal for all investors. Next, the purchase and sale transactions can be taken in infinitely divisible units. This is followed by the next assumption, which is that the personal income taxation is assumed to be 0 and there exists no transaction cost, that is, there is perfect competition in the market. Returns are not affected by the inflation rates in a capital market, as none exists in the capital market theory. And lastly, it is assumed that the markets are efficient and there is no mispricing of assets within the market. Now, we shall discuss riskless lending and borrowing. The capital market theory assumes that there exists riskless lending and borrowing among the investors. In other words, investors can lend or borrow any amount of money at the risk-free rate. This is noted as capital RF in brackets. As explained by the Markowitz portfolio theory, the efficient frontier is the concave part of the curve that extends from the minimum variance, that is the risk portfolio, to the maximum return portfolio. The efficient frontier assumes that all the securities on the efficient set are risky. This is shown in the figure below. In this figure, the x-axis has standard deviation and the y-axis has expected return. You draw a concave curve on the left hand of which you have minimum variance portfolio, and because it is extending upwards, this has got the maximum return portfolio. This specific curve is called as the efficient frontier, and the figure can be labeled as efficient frontier of risky assets. With the introduction of risk-free assets, this efficient frontier undergoes a change. The correlation between all the points in the feasible portion of risky portfolios and the risk-free rate, denoted by in brackets capital RF, is 0. Suppose that an investor is interested to place a portion of his investments in the risky portfolio A, which is a point as explained above on the efficient frontier, and their remaining portion in the risk-free assets. This combination is a new portfolio. This can be denoted as X as the portion of investment in A and denoted as L minus X in brackets as the portion of risk-free asset. Now, the expected return and the variation of the new portfolio can be explained through an equation. Capital E brackets capital RP will be equal to, in brackets, X capital E in brackets capital R A brackets enclosed plus 1 minus X in brackets capital R F brackets enclosed. This is equation A, and equation 2 or equation B will be sigma square P will be equal to X square into sigma square A plus 1 minus X whole square sigma square F plus 2X into 1 minus X sigma AF. This is equation 2. Since sigma F is equal to 0 and sigma AF is equal to 0, then variance is simply given by sigma square P is equal to X square sigma square A, and this translates to sigma P is equal to under root of X square sigma square A, which will give you X sigma A. Substituting, therefore, X is equal to sigma P upon sigma A, which will be equation 3. By substituting equation 3 in equation 1, we get E brackets capital RP is equal to sigma P upon sigma A into capital E capital RA in brackets plus brackets 1 minus sigma P upon sigma A brackets closed into capital RF. This will be equal to sigma P upon sigma A into capital E capital RA in brackets plus RF minus sigma P upon sigma A into capital RF again in brackets. This will lead to capital RF plus sigma P upon sigma A into in brackets E capital brackets R capital A minus capital R F in brackets. What does this imply? This implies finally that E capital brackets RP is equal to capital R F plus within curly brackets E capital R A minus RF upon sigma A brackets closed into sigma P, which gives equation 4. Graphically, equation 4 is a straight line that has an intercept of capital RF and a slope in curly brackets capital E RA minus RF upon sigma A brackets closed, and it passes through portfolio A. Portfolio A was chosen arbitrarily. Likewise, some other investors may choose portfolio B, portfolio C, or portfolio D. What could be the best combination for the investor? Clearly, a line that is tangent to the efficient frontier would provide a solution to this problem. This tangent line dominates any other line between capital RF and any point in the feasible region of risky securities. This is shown in figure 2. Figure 2 above shows the efficient frontier with lending and borrowing opportunities. Although the investor can choose either of the portfolios A, B, C or D along the efficient frontier curve PCQ, or reach any point on lines 1, 2 or 3. None of the point is optimal. Line 4 is tangent to efficient set of risky securities at point M. It provides the best possible opportunities to the investors. It is clear from the figure that line 4 dominates all the other lines. Also, any point on line 4 is superior to the points on PCQ. To see, point E on line capital R FMG offers higher expected return than point B on PCQ, but with the same risk. Also, point G on RFMG provides the same expected return as point D on PCQ, but with lower standard deviation. Thus, if borrowing and lending at risk-free rate is introduced, the efficient frontier is a straight line. Next, we see the following figure. Now, let's have a look. The investor has the following choices. Number 1, invest all his wealth in portfolio M, or invest some of his wealth in portfolio M and the remaining in RF, which is point E, that is for lending, or borrow more funds to invest in portfolio M, which is mentioned through point G, that is borrowing. No other investment or combination of investments available is as efficient as point M. The decision to purchase M is the investment decision. The decision to buy some riskless asset, lend, or to borrow, that is leverage the portfolio, is a financing decision. This condition gives rise to what is called as the separation theorem. The theorem implies that all the investors, whether they are conservative or aggressive, should hold the same mix of stocks from the efficient set. They should use borrowing or lending to attain their preferred risk class. Moving further, let us now learn about capital asset pricing model. The capital asset pricing model was developed by William Sharpe in 1964, John Lintner in 1965, and John Mawson in 1966. Their work was based on the foundations of modern portfolio management laid by Henry Markowitz in 1952. CAPM, or capital asset pricing model, predicts the relationship between the risk of an asset and its expected return. It helps in the identification of different securities, whether they are individual asset or portfolio, as overpriced or underpriced, by assigning values which may not be exact to these securities. These would help in selection of securities to be included in the portfolio by the risk-averse investors. CAPM talks about the ex ante returns, which is the returns that are expected in future from an asset. This return shall compensate the investors for the following, that is premium of time and premium of risk. Time premium is called as the compensation or reward for waiting, as the current consumption of money value is sacrificed for the present or proposed to the future. It is the compensation for the loss in value of the money. This compensation should be at least equal to the returns on risk-free assets, as this is the minimum expected return that one can have from his investment. The risk-free assets are, however, subject to interest rate risk and inflation risk. They are free from default risk. Risk premium or premium risk. It is the reward for assuming risk by the risk-averse investors. Their desire for return increases with the increased quantum of risk assumed by them. The risk premium is nothing but the compensation over and above the risk involved in riskless assets. The risk premium increases with the increase in risk. In other words, higher the risk, higher the probability of return, lower the risk, lower the probability of low return. Assumptions of capital asset pricing model. CAPM or capital asset pricing model is based on the following assumptions. Number one, the investors are risk averse, that is, they attempt to avoid risk. Number two, investors seek to maximize the expected utility of their portfolio over a single planning period. Number three, each security in the market has only two attributes on the basis of which these are selected in the portfolio. These are mean returns and variances of such returns representing the risk. Number four, investors have homogeneous expectations, that is, they have identical subjective estimates of means, variances and covariances among returns. Number five, the investors can borrow and lend freely at the riskless rate of return. Number six, the market is perfect. There are no taxes, there are no transaction costs, securities are completely divisible and markets are competitive. Number seven, the quantity of risky returns in the market is a given. Now, the model determines the prices of securities in such a manner that the risk premium or excess returns are proportional to the systemic risk measured through beta. It takes into account the asset's sensitivity to the non-diversifiable risk as well as expected return on theoretical risk-free asset for deriving their theoretical required return, also called as the discount rate for an asset in the market. Mathematically, CAPM or capital asset pricing model is expressed as capital E brackets Ri is equal to capital Rf plus beta I brackets capital E brackets Rm minus Rf brackets close, which gives equation 5, where beta is the measure of assets sensitivity to movements in the overall market. Beta is usually found through regression on historical data. Beta more than 1 denotes more than average risk and beta less than 1 denotes less than average risk. Capital ERM minus capital RF denotes the market premium, the historically observed excess return of market over the risk-free rate. Once the capital ER, which is expected return, is calculated using CAPM, this rate can be used for discounting the future cash flows of the asset to their present values for establishing the correct price of the asset. We shall now discuss the capital market line or CML. CAPM says that all investors will hold combinations of only two portfolios as we discussed above, that is the market portfolio and the riskless security. The market portfolio is a combination of all risky assets in the market. The weight of each asset in the portfolio held by the investor will be proportional to the weight of the assets in the market value. In other words, each asset will be held in the proportion of its market value to the market value of all risky assets. CML represents this combination of risk-free assets and the market portfolio. It is a straight tangent line emanating from the point of risk-free asset to the set of efficient portfolios of the risky securities. That is the efficient frontier as we have discussed in the above figure. The point of tangency represents the market portfolio, which is an efficient portfolio comprising all risky securities. All efficient portfolios will lie on the CML, including the market portfolio. Portfolios having returns that are perfectly positively correlated with the market portfolios are referred to as efficient portfolios. All points on the CML have superior risk return profile as compared to any point on the efficient frontier except point M, the market portfolio. All investors would choose portfolios somewhere along the CML. All inefficient portfolios lie below the CML, and this CML is presented graphically in figure as. Now, CML depicts the relationship between risk, that is standard deviation, and return for all efficient portfolios, including the market portfolio. This relationship is given mathematically and represented through equation 6 as capital E RP is equal to capital RF plus curly brackets E RM minus RF upon sigma M curly brackets closed gives sigma P, where E RP is equal to expected return on the portfolio, capital RF is risk-free rate on price of time, sigma P is standard deviation of the portfolio, sigma M is standard deviation of the market portfolio, and the slope of the CML is explained through E RM minus RF upon sigma M. This can also be thought of as the extra return that can be gained by increasing the level of risk on an efficient portfolio by 1 unit. Thus, the expected return of an efficient portfolio is expected return is equal to price of time plus price of risk into amount of risk. Price of risk into amount of risk should be in brackets and price of time should be separate. From here, we move to the security market line. CAPM explains the relationship between expected return and risk. CAPM believes that in an efficient market, it is the systematic risk that is much more vital. Since the systematic risk cannot be eliminated or reduced through diversification, it demands proper management. On the other hand, the non-systematic risk can be reduced to zero through diversification. It is thus irrelevant for investors. Hence, it is the systematic risk for which investors are rewarded or compensated. Systematic risk is measured through beta. Beta is the sensitivity of securities return to the movement in the general market index or the market portfolio. CAPM describes that expected return of a security is linearly related to its risk, which is measured through beta. This obviously means higher the beta, higher the expected return, and vice versa. The basic theme of CAPM is depicted through a straight line called the security market line. The individual securities and inefficient portfolios lie below the CML and are found all through the feasible region. There exists no linear relationship between their expected return and standard deviation or variances. However, there exists a relationship between their expected returns and their covariances with market portfolio. This relationship is graphically presented in the form of a straight line called the security market line. Can be represented mathematically through equation 7 denoted by capital ERI is equal to RF plus ERM minus RF upon sigma square M in brackets, which gives you CIM. This is called, as I said, equation 7, where ERI is equal to expected return on security I, RF is the risk-free rate as explained earlier, ERM is the expected return on market portfolio, sigma square M is the variance of return on market portfolio, CIM is the covariance of return between security I and market portfolio. In other words, the SML is expected return on security I is equal to risk-free rate plus price per unit of risk into risk, where ERM minus RF upon sigma square M, as explained earlier, is the price per unit of risk. CIM, as mentioned earlier, is the measure of risk. Since, as we now know, BI is equal to COVIM upon sigma square M or sigma IM upon sigma square M. This can be expressed as below. ERI is equal to RF plus ERM minus RF into beta I. Can be represented through equation 8. Also can be denoted as expected return on security I is equal to risk-free return plus market risk premium into beta of security I in brackets. Thus, SML is a straight line representing the CAPM. We determine the SML by connecting the risk-free rate, that is the intercept of the line, to the market portfolio M with beta is equal to 1 and the return of RM. This is shown through the figure below. This is figure 5. In figure 5, the upward sloping straight line represents the security market line. SML forms the efficient frontier for the identification of undervalued and overvalued securities. The securities lying above the SML are considered to be undervalued, whereas those lying below the SML are considered to be overvalued. All the correctly priced securities lie exactly on the SML. The difference between the actual expected return and the fair return as per SML is called the securities alpha, denoted as alpha. Let us now recapitulate what we have learned so far. Number 1, the capital market theory develops a model for determining the price of risky asset in the capital market. Number 2, the capital market theory assumes the existence of risk-free asset, risk-free lending and borrowing among the investors. Number 3, with the introduction of the risk-free assets, the Markowitz efficient frontier undergoes a change. The resultant efficient frontier is a straight line. Number 4, all investors hold only the market portfolio and the risk-free securities. Number 5, the capital asset pricing model predicts the relationship between the risk of an asset and its expected return. Number 6, the model determines the prices of securities in such a manner that risk premium are proportional to systematic risk measured through beta. It takes into account assets' sensitivity to non-diversifiable risk as well as expected return on theoretical risk-free rate. Mathematically, ER1 is equal to RF plus beta I into curly brackets ERM minus RF brackets closed. Next, The capital market line is a straight line emanating from the point of risk-free asset to the set of efficient portfolios of risky securities, that is the efficient frontier. We've also discussed that all efficient portfolios lie on the CML, including the market portfolio. CML depicts the relationship between risk, that is the standard deviation, and return for all efficient portfolios, including the market portfolio. Mathematically, it can be represented as E brackets Rp is equal to Rf plus E Rm minus Rf upon sigma m in brackets multiplied by sigma p. This is followed by the fact that the basic theme of CAPM is depicted through a straight line called the security market line. We also next learned that this security market line shows the linear relationship between expected returns and the betas of the securities. The SML next is an upward sloping straight line passing through the market portfolio with an intercept at the risk-free return securities. Mathematically, E Ri is equal to Rf plus E Rm minus Rf upon sigma square m in brackets multiplied by Cim. The upward slope of the SML denotes that greater expected returns at company higher levels of beta. Last but not the least, return expected from an investment or portfolio is a combination of risk-free asset plus market risk premium sensitive to the security. This can be represented as E Ri is equal to Rf plus curly brackets capital E Rm minus Rf brackets closed into beta I. This was an overview of the capital asset pricing model. Thank you.